Everybody, and welcome back to another episode of the Indy Investor Pod. I got Mr. Jared Shore joining me today. Excited to jump in and just talk about money, interest rates, all that kind of stuff, all the fun conversation. So, Jared, how's it going, brother?
It's going well, man. I appreciate you having me on. Excited to be on.
Yeah.
I love watching your podcast. So to be on it, I feel privileged, man. So thank you.
There you go. No problem at all. It's been too long. You know, we should have had you on last year digging in all this stuff and things, but glad we could actually, yeah. So
I would have been too busy last year, man. 2020, 2021, I don't think I've slept since then. So finally getting a little bit of chance to relax. And it was two really, really busy years that we were not expecting. So we'll take it.
Yeah. So have things slowed down a little bit for you? So before we get into that, like, give us a little bit of your background, kind of tell us who you are a little bit, how you got into kind of what you're doing today and what your company's doing and what you guys can put out there for everybody.
Absolutely. So, so I've been working for Finance of America for, I guess, a little over 3 years now, but I've been in the mortgage industry since 2013. So, I've seen it all. We do first-time home buyers. We do, moving on up. We do investors, obviously. So we do a little bit of everything. And I think my experience, because I've been doing this for so long, knowing how to do a mortgage is hard enough in and of itself, right? And then, so you have to kind of understand how a mortgage works first, then to be able to understand how it works with an investor. Yeah. I think what I bring to the table really is kind of that experience. Just I've seen it all, right? And every day I see something different, but there's usually a scenario that I can relate back to help with a file that we're working on. Finance America, who I work for, we do everything from conventional FHA, VA. We have a lot of proprietary loans that we do in-house, as well as LLC lending, portfolio loans, fix and flips, kind of all the necessary loans for investor clients.
Yeah, awesome, man. So let's get back into kind of what you're touching on then. So you said the last 2 years has been a little bit crazy. So have you seen a change or anything compared to, last year coming out of 2021, coming into 2022? Has it slowed down a little bit? Has there been a change? I know we'll obviously get into interest rates, not that whole conversation, but what have you seen coming off of 2021 right now?
So I would say, no, things have not slowed down. Yeah. It's just where we're putting these loans are different. Where 2020, 2021, speaking specifically to investor deals we were doing almost, probably I would say 90% conventional loan, just because rates were so crazy low, right? What we've seen going into 2022 here is it's almost been flip-flopped, right? All those loans that we were doing kind of on the conventional side have moved over back to the LLC side. And we'll talk a little bit more about why that is, but that's really been the big difference going into this year, is that there's been a big move towards more commercial style, LLC style loans, which in my opinion, I think is a good thing, for the investor side, just from, for an asset protection piece of it. But yeah, that's because of the market and the market shift. Hasn't been a slowdown. It's just which route we go in terms of getting the financing done.
Yeah. Why do you think that is? Do you think that just stems from maybe investors being a little bit more educated, or just like realizing that is that just like the latest fad, or is it like, hey, people are like,
it is really strictly interest rate driven.
Yeah.
The reason people were moving towards conventional loans is, you'd be throwing money away essentially because of how low those interest rates you could get locked in during those times. So now that we've seen interest rates going up conventionally, we've seen interest rates stay pretty steady on the LLC side. So, I never would have thought in my career as a mortgage loan officer that I would say an LLC loan is better than a conventional loan, right? And right now, at least today, right?
Yeah.
It is. Now ask me tomorrow after we record this, it's going to make a liar out of me, right?
Right.
But at least for right now, that's kind of what we're seeing, is that just the rates are just that much better, because they're not tied to anything, right? They're not market driven, they're not bond driven, things like that. So
yeah. So I want to ask you too, just like kind of starting off, let's say that we have a new investor that's like coming into this, like, okay, I want to sit down and talk to Jared about what they can provide, what they can offer, like what I need to do. Like, what are some things that investors basically need to kind of, how do they get their ducks in a row? What do they need to have ready before they come talk to you and say like, hey, just instead of just sitting down and be like, hey, I want to be a real estate investor, what do I do? So what are some things they need to do to get in line and be ready to go with that?
Sure. I mean, there's really three buckets I'm looking at, right? To make sure that you are a qualified candidate to get financing from us. One, obviously, we want to make sure your credit score is good, or at least in a qualifying range. The higher the score, the better. It's going to give you more options there. So credit score is really what I'm looking for. Income is a funny one because some of the loans, I don't even care if you have a job, right? These are, they're DSCR style loans. So we don't care about your income. It's all based on the cash flow. So if you're doing a conventional loan, I care a lot about your income. So just making sure you have your income documentation in place. But the most important thing that I'm looking for is, do you have the cash to invest to buy a property? I think the biggest phrase, and it drives me nuts, is, and it's a phrase that you've probably thrown around, I've probably thrown around, it's using other people's money to buy properties, right? And the notion that I get a lot of these newer investors is, well, I heard on somebody's podcast that you could buy a property without any of my own cash. And while that is true, there are some scenarios you can do that, right? You got to have money to invest. That's why they call it real estate investing, right? You do have to have some skin in the game. So just having a pot of money that's sitting available that you can throw down to invest.
Yeah, I think we all hear that a lot of like, oh yeah, using the other people's money and stuff like that. Well, you didn't tell me that was like really your 10th deal that you did, that you used other people's money on, or you had the stability, or you had the background to show that you had the money to put into it if you needed to, and stuff like that. So,
for sure.
Yeah. So I know one of the questions that I get asked all the time when I'm talking to, some of our buyers, some of our investors, of like, hey, who do I go to for lending and things like that? I know through Cyria, you got some great relationships with some hard money lenders and some various types of lenders and stuff like that. So like, when do you guys just sit down and be like, oh no, I'm going to take this investor, you take this one? Or how do you kind of talk somebody through that of like, hey, maybe you'd be better off using this type of money, or have you thought about private money or hard money, or no, this type of, mortgage would be a better one for you? Like, how do you go about having that conversation, making sure you get the right fit for everybody?
Yeah. What I always tell my clients is, I mean, I try to be as much of a one-stop shop that I can, right? So, hard money is really about the only piece that I don't have. We have a pseudo money loan, but the biggest difference is money lender can. So what I always tell people is, let the property and the seller to dictate, what loan you're going to use. Get the property under contract, come to me then and say, hey, we've got this property. Here's the details of the contract. What's the best route here? And then let's figure it out. So there's just so many options that you can do, to kind of give a general overview and say, hey, this is what you should do all the time. And I think that's, one of the things I bring to the table, that a value add, if you will, is we can sit there and we've got multiple resources to say, hey, you should do this, you should do this. But again, it's property driven, it's seller driven. So I think that's probably the biggest indicator for me, is which route we go, is how flexible is the seller and what type of property we dealing with.
Yeah. So how let's kind of focus on that property aspect of it, of like, how many, like, is this like your everyday, where it's like, hey, this property doesn't fit for what you want to do, you're trying to put, a square peg in a round hole? Or is it like, hey, okay, you have this property, let's navigate through it and try to figure this out and problem solve it, which one would be best? Like, is it, I guess that's kind of a little bit of a chicken or egg situation there, but how do you navigate that with, especially maybe a newer investor versus, kind of a seasoned investor or something?
Sure. I think it's a little both, right? Like, sometimes it's property type, right? The 1 to 4 unit properties are the easiest ones, right? Like, we can do those anywhere. It's getting into the 5+ units, or you've got this, the big question I get asked all the time is, hey, there's a investor that's selling their entire portfolio of properties. They've got 15 deals. Most of them are single families. I want to buy them all. Like, what do we do? And so that's where it gets a little bit more tricky, right?
Yeah.
But if it's single family 1 to 4 unit property, it really boils down to purchase price at that point, and making sure that it fits into our minimum loan amount statuses, which ours are pretty low compared to the rest of the industry. So just making sure that it fits in there. Does it need rehab, right? Is it a turnkey property? So some of that stuff, and a lot of that, we're going to have that conversation up front before you go find that property. But I get those clients that say, hey, we've never talked about this one before. We're under contract. Let's go. And then it's a rat race.
Hey, I got this deal under contract. I'm ready to roll with it. Yep.
Well, and we get it. I mean, the hardest part in this industry right now is just getting properties under contract and finding deals, right?
Yep.
So time is of the essence, and sometimes there's just not enough time to go look at a property, call me, figure out the financing of it. Like, it's, hey, let's get it under contract and then figure out the rest.
Yep.
So we get it. It's not ideal for us, but it's part of it.
Yep. I just had that conversation with my team yesterday. Hey, we're going to run right now. We'll walk later on. We'll figure it out later. Let's just run right now and then we'll get this under contract.
Yep.
That's cool. So I know sometimes, people are bringing a property to you and saying like, hey, I'm going to buy this property. I get this under contract or whatever. Let's talk about ones that they already own and they're ready to refinance and kind of get that figured out. Is there anything that you see like investors like really need to get ready, or is it what I think a lot of investors get in this aspect of like, hey, do I refinance one at a time, or should I refinance like 5 of them together at a time as a package? Or what's some just advices you have for people that are trying to look into doing that, or maybe just thinking about doing that, of like, when do I refinance? When's the right time? What do I do? What do I need to be ready for it? All those types of things.
Yeah, no, good question. The refinance side is a little less stressful for us because we're not up against a time frame, right?
Yeah.
We don't have real estate agents. We don't have a purchase contract date. Now we want to get these closed as quickly as possible because every investor wants their cash now, right?
Right.
They'd love to close these things yesterday on a refinance side, but we have a little bit more time to do our due diligence on these. So really, it's just making sure, for one, depending on what type of loan we're doing, DSCR loans, you want to make sure you got your renter in there. All right. You want to make sure you've got contracts signed. You don't expect it if you don't. So if you can get those renters in there, get the lease agreement signed, that's your income, right? On these deals. You want to make sure this is a cash flowing property for us before we go down the rabbit hole of doing a refinance. 2, just making sure you've got cash reserves. Okay. It doesn't matter what loan you're doing, whether it's a DSCR loan, a conventional loan. If it's a rental loan, you're going to have cash reserves. And these are, they can be in almost any account, but a liquid account is going to be more ideal for us.
Right.
So you got to have cash reserves. Rule of thumb, 6 months of whatever the mortgage payment's going to be. It could be a little more, it could be a little less, depending on credit scores, experience, things like that. But that's kind of the rule of thumb. If you got 6 months, you're probably golden.
Yeah. Let me ask you a question on that real quick. Has that changed since COVID? Because I just know once COVID happened, I mean, I heard a lot of seemed like in my world, I heard a lot of like, hey, 3 months reserve, 3 months. Now all of a sudden COVID happened. Like, okay, let's make sure we have 6 just to protect ourselves because people were distracted. Has your philosophy changed that at all? Or is like, no, I'm a conservative person. I'm going to go 6.
No, it's 6 is always where I want to start. And then at least from initial underwrite, the actual underwriter is going to tell us what reserves you have to have. Conventional is a little bit more confusing if you've got multiple properties financed. It becomes a percentage of your unpaid principal balance on any loans that you have. And so the more loans you've got financed, the more you have to have. And so it's not just a standard, hey, 6 months of, it's actually a percentage, and it tiers up based on your balances you own. So that's where it gets, again, every person's scenario is going to be a little different. So that's, 6 months. Like I said, if you have 6 months, you're probably pretty good.
Yeah. Nice. What are some, I want to put this out there, especially for people that are, because I see this all the time of like people get into this and they realize like, oh man, this isn't exactly what I want to do, or, oh man, I should have done it this way or whatever. What are some of maybe the mistakes that you see, investors making as they're getting into this down the road that you're like kind of maybe you foresee it coming, or you're gonna cringe because you're like, oh man, this guy needs to be careful of this, and I warned him.
Yeah.
But what are some of those mistakes that you see that you like to just put out there, like, hey man, come on guys, let's get this corrected and you'll be a lot better off?
Yeah, I'll tell you. So there's two really big mistakes that I see. Is one, newer investors not doing their due diligence on what they think their ARV is going to be. Or I guess really more elaborating on that is they overestimate what their ARV is going to to be. And so then,
or they trust somebody's opinion on what they think the ARV is going
to
be.
Yep. They see it and they're like, oh, that's, it all looks good. Then they buy it, they rehab it. They come to me to refinance it, and they, we're only as good as the information we have, right?
Yep.
They tell me that the property value is worth X. We get the property appraisal back, and it's well underneath that, right? Yeah. And guess who looks like the bad guy in that situation?
Right.
Me. Right. All right, hey, your appraiser is bad, like blah blah blah. And to be fair, there's been bad appraisals, like so we've got that to deal with, which those appraisals are all third party people, so you can imagine how, like, what little hair I've got anymore, I just want to rip it out sometimes.
Right.
So you've got that. So it is just not a fun place to be if you're really tight on your margins. You have no room for error from an appraisal on the refinance side.
Yeah.
So whether it's not knowing your ARV number, or if it's over leveraging the upfront purchase, it kind of all ties into the same. And I think that's probably the biggest mistake that I see from the refinance side on these is either they're over leveraging upfront, or they're not really realistic about what what the appraised value is going to be. Yeah. You really should have a really great real estate agent to help you with that, to make sure that exactly, or at least pretty darn close what your appraised value is going to be. And there's some tips and tricks, to help alleviate some of that. But the other one that I see, and I don't see this often, but I see it probably with newer investors the most, is they don't do their due diligence on where a property is located. They see a property, the numbers work on the property, but the property just isn't in an ideal location.
Yeah.
We had one, the property, again, the numbers worked on it. The numbers were great if you're just looking at it from a cash flow perspective, but the property sat in between two businesses. It was a residential property sitting in between two businesses, and they couldn't get a good appraisal on it because it was in an industry park, right? And they didn't know that. They bought that property sight unseen and didn't do their due diligence on where it was located at. And so I've seen, that's one example. I've seen multiple examples of newer investors just buying properties close to the numbers.
Yeah. And I mean, sometimes when you're in a situation like we just mentioned a little bit ago, like one of the toughest things right now is just to get a property and get it under contract. So sometimes too, people just rush into it of like, oh man, I just need a contract. I'm gonna get this one under contract right now and just go with it.
Yep.
Just because you're trying to do something. So yeah. What are is there anything out there that you feel like
don't be scared to say no? There'll always be properties up.
Yeah. No, that's very true. So there's always gonna be properties, there's gonna be more and stuff like that. So I know sometimes it's like, let's just jump on it when you got a chance. But yeah, there will always be properties. So I always like to say too, like, no deal is better than a bad deal. So I've been in that scenario before. So I'll take the no deal over a bad deal. But are there, Jared, from your standpoint, are there anything that, like, right now that investors should be taking advantage of that maybe they're not yet right now yet?
Oh man, it's a hard one because there's not much positive going on in the real estate industry right now. That rates are going up, prices are going up. So I would say the biggest thing is again just getting properties under contract.
Yeah.
Take advantage when you can, smartly, right?
Right.
But take advantage when you can get that property under contract, and if the numbers work, don't hesitate. Go get it. The kind of the analysis paralysis, if you will. That's probably the biggest mistake that I see people right now is if you've done your due diligence, you've got your team in place, trust your team and let them make money for you.
Yeah, I like that. That's good. As far as, you just mentioned too, like interest rates going up a little bit. So how is that affecting the real estate world right now, especially the investing world? How's that kind of affecting how you see people buying, or just kind of, where things lie down the road with that? Like what's your kind of, I guess, crystal ball prediction on kind of what's going on with it and what's happening too? So I'm putting you on the spot here with this one.
Yeah. Oh man. I think so for people that started getting into the real estate investing world, 2020 and beyond, right? There's going to be a big shock to them moving forward because they've never seen interest rates in, let alone the fours, right? But seeing interest rates in the fives moving forward. And to put that in perspective, right? Post or pre-COVID, like January, February of 2020, interest rates for conventional loans were like, for investment properties, we're like in the 5 and 6 range, right? You might get in the fours, but so we've just been spoiled over the last 2 years of these interest rates. So really, you take away COVID, you take away, the crazy rates that we've seen over the last year, we're really at a pretty good spot. Like we're really still at really low rates.
Right.
I think the unexpected thing that we've seen is the LLC rates going down. Original rates were pre-COVID 2020. If you put that in perspective, that's pretty dang cool, right? That we're able to close loans in an LLC at where conventional rates are or were, right before COVID happened. So that's pretty neat. The downfall to that is, you've got rates going up pretty drastically on the conventional side. And that has a lot to do with, bonds and stocks and all that. The ironic part is today rates went down about 0.5%, at least with the bonds. They'll probably go back up tomorrow. But, you've got the war in Ukraine that's affecting that. You've got all this stuff, right? The Fed's raising rates, all this stuff that's going on. I don't know what's going to, my crystal ball, some of the experts think that we're going to see obviously rates go up for 2022. And then we're going to see a drastic decrease in rates in 2023. We're going into an election year, 2023. Who knows what's going to happen with the housing market industry. Some people are saying that we will see lower rates in 2023 than we've seen in 2020 and 2021. So I'll believe it when I see it. But if it happens, that's great. I mean, take advantage of that. But
so we'll just tell everybody just buy now and then refinance next year. Then, right? Is that what you're saying?
Yeah. That's buy high, sell low, right?
So there you go. So awesome. I want to ask you. So this is kind of a little bit. This is a good Indy investor pod question, but it's a little bit of a Brian Snyder question as well, because I'm pretty sure last week I heard myself I caught myself saying like, oh my gosh, I hate working with lenders. Like I know I said that at some point last week. So let's talk a little bit about, like, for somebody like me who's selling 200, 300 properties a year, or just anybody that's selling properties, like, what are some things that we can do as a seller to make things just make things a little bit easier for the lender, or make sure things stay on track, or on the right timeline and things like that? What's something that I can do from my standpoint as a seller to just help a lender out?
Yeah, I think the biggest thing from the selling side is just the time frame. Being very realistic and flexible with a closing date. There's so many. The biggest thing that's holding us up right now are appraisers, right? Appraisers are so booked up that, I mean, they're taking 30 days sometimes just to get an appraisal back in some situations. I see that backing up a little bit. Those turn times are getting better, but there's just things that just are completely out of our control. For us to get a loan approved, it doesn't take that long, right? There's just so many things that are going on the back end. So I think as a seller, just knowing that, like, hey, there's they're working just as hard. They want to close this just as bad as you do,
exactly.
right? You know, it's a team thing. I think the biggest thing that we look at is the seller, the list agent, the buyer's agent, the buyer, the seller, us, the title company, the appraiser. We're all on the same team, right? We're all trying to accomplish the same goal. So, you know, there's just being flexible with us, and really what that does is that's a reflection on the buyer, right? Just that they want to come buy properties with you again and again and again, making, you know, if you're difficult on the seller side, you know, they don't want to deal with that again, right?
So
so I think honestly that's the biggest thing for us is just the sellers being flexible.
So that's something I've learned of, like, kind of just like my communication is just like, I start off just saying like, hey, just be honest with me and transparent, and just let me know what's going on. If something messes up, like, I honestly just don't care. I just want to be in the know. So I realized lenders like, hey, same thing too. Like, I just need to know the same thing. Like, all right, we're on the same page. We're good to go. So
well, here's the catch-22, right? With the market we're in, such a seller's market, right? That to get a contract under, like, if you've got 20 contracts in place and you see a purchase agreement that says 45 days on it, and you got another one that says 30 days on it, right? You're going to take that 30-day one all day.
True.
That doesn't mean it's going to close in 30 days, right? So there's this game. So as a seller, you just got to know, like, hey, this offer may have looked better up front, and that may have got you the contract, but you got to know it may close a little longer than that. And we want to close them in 10 days, right? We want to close them as quickly as we can. I don't want to have to deal with y'all for 45 days. 30 days is long enough. So
no, love it, man. So Jared, what's something that we haven't talked about that you would like to just kind of throw out there? Any last words of wisdom, or something that investors should be thinking about, or that you want to throw out there for everybody?
Yeah, I think one of the things that we've seen in the market on the lending side, and we haven't really marketed a lot of it yet, just because rates are still pretty low everywhere else, is there's some new crazy loans coming out on the refinance and purchase side. Some low down payment options with no mortgage insurance. You can go as low as 10-15% with no mortgage insurance. They kind of are transitioning from DSCR loans, to more like bank statement loans, 1099 loans, where we know the biggest problem we have on the conventional side for somebody that's self-employed, for example, we know you make money, right? But on paper, you make no money. Right. And so to be able to take advantage of your income outside of just DSCR loans, is there are loans out there now that just, they're more common sense. We know you make money. We just have to show it on paper. And there's alternatives to that. So there's some alternative loans that are coming out. I think we talked about appraisers, right? And how just the time frame. Fannie and Freddie just came out. They're going to start allowing more desktop appraisals and appraisal waivers. Nice. So I think we'll see the time frame of loans shorten up that way. On our DSCR loans, if we get to a certain loan amount, and really a certain loan to value. So if you put more down, like a 30% down payment, we'll allow for no appraisal, more of a desktop underwrite on the appraisal. So I think we'll see those time frames control. So they're kind of taking the control back of that a little bit, for some more alternatives.
I wanted to ask you, because you brought this up, and this is a really good point, and this is something that I forgot to bring up, but like, for a lot of people that are, as investors, you might not have that regular W-2 job. You might not be able to show that income, or just in general, there's just more entrepreneurs out there, or more people that are doing remote work, or working, not necessarily working for a company, doing freelance work and things like that. Is there anything from your standpoint that they could be doing to maybe make them more bankable, or make them, be able to get that loan a little bit better? Is there something they could be doing if they don't have that W-2 income to show it?
Sure. Right now, DSCR loans are the best. Because like I said, we don't care about your income at that point. It's all cash flow based.
Yep.
and you can close those DSCR loans in your personal name or an LLC too. So I love those loan options for that. I think that's where I would probably put somebody in that situation. Because right now what we're seeing is the rates on kind of these alternative valuation of incomes are still slightly higher than the DSCR side of things. Who knows where that's going to be in 6 months from now? Right. But I just think you're going to see a lot more. It's going to feel wild west is what I think is going to happen. There's going to be a lot of loans that are going to come out that you're going to be like, I can't believe they're doing that. We have a 40-year interest only loan.
Oh, wow.
We just launched. We have a 30-year interest only loan for investors. So a lot of cash flow based loans that are we haven't seen on the market in a long time.
That's awesome. That's exciting. That's great, man. So
yeah.
All right, man. Well, I really appreciate your time, and I really appreciate you coming on here and just providing some insights. And I thought there were some really great nuggets in there for people to really grab a hold of. And I know people are going to come out of this too. And after they listen to this, they're going to have a ton of questions and want to know a little bit more and things like that. So what's the best place for them to go to learn about some of the stuff that we were talking about, learn about what you're doing, or just to reach out to you and figure out like, hey, man, I want to go talk to Jared and figure out what's going on.
Sure. Couple things. I'll give a quick Cyria plug here.
Yeah.
We teach a subgroup third Monday of every month. We teach a class on financing for investors. So we host that at our office as well as Zoom. So if you're a Cyria member, that's a great spot to go. And really just get a hold of me. I'll put my email address. I don't know if you want to post that, or I can. It's real easy. It's jared.shore@financeofamerica.com. Shoot me an email and we'll get you on the calendar. We'll just have a one-on-one chat. I mean, that's what I love doing, is just chatting one-on-one, learning about what you're looking to do, and then kind of customize, those loan products to make sure it fits into your goals.
Yep. I think that's the big key right there. Just like we were kind of talking before we even started, recording or anything, of like, I know for my world, every wholesale deal is different, and every property we buy and sell is different. Every mortgage you do is different and stuff like that. So really, that's what it comes into, of like, hey, let's sit down, let's have a conversation. Let me know what your goals are, and let's figure out what's the best thing for you long-term. And that's what it's all about. So.
Yep.
Awesome, man. Well, thanks a lot, Jared. Really appreciate you jumping on here today and sharing with us all the insights that you brought. But that's a wrap for this episode of the Indy Investor Pod, and we'll see you guys next time. Take care.